All right. Happy Wednesday, everybody. Let me know if you can hear me. We're going to go ahead and get started. Really excited about the stuff we're going to be going through today because it applies to everything. I mean, we're going to frame it in terms of investing, but you saw it a lot, during the election and in the follow up to the election and in the coming political stuff you're going to hear down in Georgia and all the different things that are going on all across the country. It's going to apply to everything. And what it really is the biggest risk in investing or in politics or in an argument with your spouse is hiding right in your own head. It's the space between your ears. The biggest risk are your own bias, we're going to go through confirmation bias and some of the other different kind of decision making errors that people make, and also hopefully help you avoid them. So just let me know if you can hear me. I'm watching along on my iPad as well, so I can see what you guys are seeing. I'm going to go ahead and share my screen and get that going. And let's see if this is looking good. I'm going to switch. Whoops, I'm giving away the middle of my presentation here. I got to scroll way up. So I'm going to just wait a second because we're on about a 30-second delay before what I'm seeing on my screen actually shows up on the Facebook end. So we're going to be covering the 6 behavioral blunders that can ruin your retirement. Like I said, these really affect everything, all aspects, not only of your life, from situations talking with your spouse and family members and even friends. If you get in an argument with a friend, my guess is over the next couple of months after going through this, you're going to start to see this a lot more in every interaction you have. You're going to go, oh, that person's showing confirmation bias. That person's showing resulting. And it's probably going to change a lot of your decision making. And I believe it's going to change it much for the better. So, hopefully you guys can hear me okay. I'm going to go ahead and get started going through the slides here. We're going to talk about the 6 major behavioral biases that you see in investing and really in the accumulation of wealth. We're going to talk about anchoring, confirmation bias, resulting endowment effect, loss aversion, and then something called Dunning-Kruger effect, which is a really interesting one that, again, you see really everywhere across all aspects of life. But anchoring is a really important one. So anchoring is a cognitive bias where an individual depends too heavily on an initial piece of information, and they use it to make subsequent judgments during their decision making. So, for example, we're going to go through a couple examples, but your first experience with living in a house. Like if you were going to go buy a house and the first house you buy, like for us, the first house we bought was a brand new house. So I didn't have a lot of maintenance. And to me, home ownership was great. I had a good appreciation and a good market, didn't have to do too much. The second house I bought is an older house. It's a lot more work. And I was prepared for that. But had it been the other way around, had I started with a, 100-year-old home with a lot of character, that was a lot of work, I don't know. I might have moved to a newer home or something. So your decision making is often affected by your earliest exposure. And once the value of this anchor set, all future negotiations, estimates, decisions, etc., they all revolve around this initial anchor. So where you see this a lot is in pricing. And what you'll see, I have a car lot here. I don't know if it's coming through clearly, but that second car there, the 17,900, that's an $18,000 car, right? They're showing you a 17 first digit to make it look a lot cheaper, even though it's only $100 less. But then also that sticker price they're showing on there is a price that they know you're going to negotiate down from. So they're of course setting that price a little bit higher. For example, right now, the house I'm in currently, when we were looking at buying it, it had a pretty high price point on their asking price. And I went all the way down, so imagine, you have a $300,000 house and the asking price on it is $350,000. Make your first offer $299,900 because it anchors them to a 2 first digit. And if they just get over the 3, even if they only get 305 or something like that, they feel like they won, even though they only really moved it a couple $1,000s. So you see this everywhere. And where we see it a lot in investing is, believe it or not, Eric talked about this in his video this week, but your birth year has a massive effect on how you view the stock market. So my generation, actually, believe it or not, tends to own less stocks than the baby boomers. And even within the baby boomers, there's kind of two different cohorts. So if you were in the earlier group of the baby boomers from like 1945 to 1955, that group tends to actually really like stocks. And then the people from 1955 to 1964 tend to be a lot more conservative in their approach to stocks. And really what it is how the market performed in the first 5 or 10 years you were investing tends to rule how you think about investing for the whole rest of your life. And whoops, we're getting my sound just turned on my iPad, so I want to make sure we're not getting an echo there. But you want to make sure that your big decisions are not being affected by the first initial impact you had. Again, as an example, if I go meet someone that's 30 years old that has all of their 401k in a stable value fund versus if I go meet a 60-year-old that has all of their 401k in stocks, both of them are wrong. Okay. Like they both are anchored to a different experience. One of them is anchored to a bull market that started when they started investing. And the other one is anchored to the stock market crashes 30% all the time. And that's kind of been the more recent experience, right? They've seen the tech bubble, then the younger generation participated in the financial crisis. And then more recently, COVID, they saw a third of their money go away really quickly. So a good tip to try to overcome this anchoring is to do what I call pre-anchor. So ask yourself, for example, when we were selling our home, we had an asking price out there. We were trying to get the other people to anchor to that price. But also when someone said, my realtor, when he said, hey, I'm gonna send over an offer, I want you to take a look at it. In my head, I had already decided what a good offer was and what kind of contingencies would be involved in a good offer. So that before I even see the number, I'm anchored to my number. I want to be anchored to my own decisions and thoughts about what's good or bad for me rather than let somebody else dictate it. And you see this a lot in negotiations. So if you've seen the movie Back to School with Rodney Dangerfield, he's given money to the school and he talks about I forget the number, but it's something like, how much should I give? And they're like, oh, $1 million or something. He's like, oh, that's not how this works. First I offer a kickball and then you counter offer that we build a gymnasium with my name on it. And then we meet somewhere in the middle and I give you a check for 10 grand. It was something like that. And that's all anchoring. So the first offers you see from people are all about anchoring. And again, when it comes to the stock market, what you see is most people's exposure to the stock market is defined by what happened in the market between the time they were 20 and 30. And it's pretty wild, but it'll go on to affect you for 30 or 40 years. So another big one is loss aversion. So there's a big study out there by Daniel Kahneman and Tversky where they say they proved through a bunch of experiments that for human beings, a loss has about twice the emotional impact of a gain. So to put that in investment terms, if I said, here's the opportunity, it's a guaranteed investment account, we know you're going to make $100 on this account. Cool, I'm going to make $100. But if I frame it as differently, if I say, hey, there's going to be a $100 fee on this side, and we can save you that $100 fee. In other words, we can take away that $100 loss. A lot of people, most people are going to actually put a lot more money are going to put a lot more confidence in the tax or fee savings. And part of that is because, of investments, it's a little bit more random. There's a little bit more uncertainty, but they proved again in that same study that the more uncertain it gets, the more it tilts in favor of loss aversion. So what that means is stocks might have to do 3, 4, 5 times what a safe investment will do because people are that afraid of the loss. And in general, what I think between anchoring and loss aversion, I think the average person right now is actually allocated much more conservatively than they should be. We're seeing people with huge cash balances, huge CD balances, and small stock allocations, and they're still really afraid of the market. They're afraid of how the election might actually, quote unquote, turn out, specifically in the Senate with the Georgia runoff elections. But I thought I had a quote in here. I must have taken it out, but there's a great Warren Buffett quote about loss aversion where he basically says the average person is so averse to losses that they never make any gains. Basically, they're so afraid of losing that they're constantly losing to inflation. And I want to move on. We're going to come back to loss aversion because it's something that really resonates throughout everything that you do around investing in retirement. But this one, confirmation bias, really affects your entire life. So we're not even talking about investments. We'll get into that a little bit, but across your entire life, you'll see this a lot, especially around politics. Let's say what it is first. So confirmation bias is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one prior's beliefs or values. So as an example, if I, we're not going to get political here, but whoever your candidate was, if I said, give me 10 reasons to vote for your candidate, the candidate that you supported, most people can rattle off 15, 20, 30 reasons. But if I said, what is one reason you would vote for the other candidate? A lot of people blank stare and they can't think of anything. And part of what we see in the digital age is people are using Google to really do confirmation bias. So they're going out and they're only searching for, show me why, so-and-so's tax plan is bad. Show me why so-and-so's policy is good. And this versus this. And then they're only remembering and recalling the things that support their prior beliefs. So there's a couple of ways to overcome this. The biggest way is whenever you're making a really big decision, try to make the case for the other side as well. Meaning, like, if you've ever been in like a debate back in school, one of the most interesting things that they would do, at least when I was going to school, is they would say, okay, here's a bunch of issues. Everybody come up here and pick an issue. And I would say, this certain political issue, and I personally am on this side of it. And then, of course, they'd go in and flip everybody. So now I have to defend this case, this argument that I don't actually personally believe in. You weren't allowed to defend your own beliefs. You had to pick a new one. And you had people arguing that were on like the opposite sides of the thing they were arguing. And it really opens your mind up. And you start to get a lot more objective about those issues when you start to build the other side's case and not so much go out and just immediately disprove it, but literally start from ground zero. If I was going to try to build this case up, even though it's something that I disagree with, what could make me agree with it? What could get me to agree with it? And then also, if you're on social media, if you're on Facebook or Twitter or something like that, I follow about 200 people on Twitter, and I'd say 40 or 50 of them I almost constantly disagree with, whether it's politics or markets or investing or tax policy or whatever. The reason I'm following them is to keep a pulse on what other people are thinking, but then also because occasionally they'll actually change my mind about something. They'll open me up to a whole new possibility. And I think it's one of the hardest things for people to do is to change their mind. And the best way to protect yourself and to protect your wealth when it comes to this stuff is to ask yourself, what conditions could change my mind? Jeff Bezos, $100+ billion net worth. His entire approach to business is he takes a default line. So let's say they're going to expand a certain business. They're going to expand into groceries or something. He says at first, which one would I regret more? Going into the grocery business or never going into the grocery business? And if he says, I would really regret never going into the grocery business, then they start an offer for Whole Foods. So, he literally is regret minimization. I really strongly believe that we need to try to get into food. And then once he moves into food, from day one, every meeting they have is basically, this is what we think right now. These are the rules where we would declare ourselves wrong. So if this, and this happens, we're wrong and we're cutting the whole venture. So let's say Whole Foods, while they were looking at Whole Foods, let's say they wanted much more money than what Amazon was willing to pay. They just say, hey, we're wrong. Or if, let's say the margins on that food business were much lower than they expected, same deal. Amazon would just say, we're out. So they're constantly operating from a standpoint of, these are the rigid rules where I'm going to decide that I'm wrong. So like in advance, I'm declaring myself wrong if this, and this happens. And that will really remove a lot of confirmation bias from your decision making. And this is a huge one. I think this is probably one of the worst decision biases in terms of how much damage it will do to the average person. And my favorite quote about confirmation bias is from Charlie Munger. If you're not familiar with him, I would not say the best investor of all time. I'd probably say like Jim Simons or somebody like that. But Charlie Munger is Warren Buffett's business partner. And I would say Charlie Munger is my favorite investor of all time. So just a little bit more from like a personality and approach standpoint. I really like his approach to everything, specifically around investing. And this quote's so good. He says, good investors ask, what if everybody's wrong? Everyone wants to be a contrarian. And they say, what if everybody else is wrong? Great investors ask, what if I'm wrong? And that's the hardest question there is to ask, but it's also the most valuable. And I think what we would all benefit from is if we looked at our portfolios, if we looked at, our financial situation and said, what bets are we making? Am I 100% bet on Apple? If Apple continues to win, I'm going to be in great shape. But what if I'm wrong? What if Apple has 10 bad years? Is my retirement in trouble? Stuff like that. Ask yourself what it would take to basically admit defeat and set it up ahead of time. So it's not as much of an ego threat to say, oh, I was wrong, I'm bad. That's not what we're trying to do. We're trying to protect your money. And a lot of that just comes from ahead of time setting a rule in place of when you decide that you're wrong. And really, I challenge everybody watching this right now. Ask yourself, what if you're wrong, especially on investments, especially if you're looking at, here's a good example. Well, actually, you know what? I'm going to save that one. We're going to talk about my truck. We're going to talk about my truck later on in Dunning-Kruger. But, ask yourself, what if you're wrong? And I think you'll end up making a lot better decisions. I want to talk about one of my favorite ones, though, and I can see Eric's watching this. So I'm going to put words in Eric's mouth. I think this is one of the biggest things that Eric taught me, and it's something that he naturally thinks this way, and I naturally didn't. I've kind of drifted this way a little bit more. But rather than give you a definition of what resulting is, I want to tell you a little bit of a story. So in Super Bowl 49, this was the Seattle Seahawks against the New England Patriots. The Seahawks had the ball on the Patriots 1 yard line. So I got a picture coming up in a second. It was right at the end of the game. They had time for one play. And any big football fan probably remembers what happens. Russell Wilson takes a snap, throws a pass. New England intercepts it. Game's over. Seattle loses. And everybody and their brother said, that was the stupidest thing I've ever seen. You have one of the best running backs in the league. You have the ball on the 1 yard line. Hand him the ball and you win the game. I'm here to say that it's not really that simple. So if you look at what was going on in that situation, hopefully this comes through clearly. But Russell Wilson, if I count this out, he had 1, 2, 3, 4, 5, 6, 7, 8, 9. You had 8.5, 9 guys in the box versus 5 offensive linemen and a tight end. If Russell Wilson hands that ball to Marshawn Lynch, he's not only not getting in the end zone, his career's probably over. I mean, he's going to get smashed. So in the moment, the way that the NFL operates, a lot of these really good quarterbacks, believe it or not, there's actually 2 play calls coming in. And one of them's a run and one of them's a pass. So I would imagine they had some sort of run called where they were going to give the ball to Marshawn Lynch up the middle. And then they said, hey, if we see 9 guys in the box, we're going to fake it to Marshawn Lynch and throw a pass. And of course, Russell Wilson's a pretty smart guy. He sees this many people in the box that are gonna stop Marshawn Lynch, and he says, we don't have a choice. We have to throw the ball. And most people that have been following football at all, you're usually in pretty good hands if you trust Russell Wilson with the end of your game. That time he got intercepted, but what resulting is all about is probability thinking, and the fancy academic word is probabilistic thinking. But you have to think about everything that's going through Russell's head when he's standing there about to take the snap and he's looking at that many people in the box. And think about it in terms of a probability distribution. Most of the outcomes, so when we're looking at this red curve over here, most of the outcomes are going to be Marshawn Lynch gets stuffed or, gets his ribs broken or something. I mean, there's a lot of guys in the middle of that field. It's going to be really rough. It could go bad. It could be something way down here on the left end. He could fumble or something like that. And then there's a 1 in a million chance that he somehow runs 3 or 4 guys over and gets into the end zone. And what he's saying, what Russell Wilson's saying is, I'm not willing to bet the Super Bowl on a 1 in 1,000 chance. I'm going to move over. I'm going to take this pass route, which yes, I could throw an interception, but more likely I'm going to throw a touchdown. Maybe on that play action pass in that situation with that many people defending the run. My guess is it would be something like a 50 or 60% chance that they're going to score a touchdown and win the game. And Russell knows this, and Pete Carroll knows this. And when they're all sitting there looking at it, they're looking at every possible outcome. And when it comes to resulting, what it means is you take that one result and then you infer something about the decision. So another example would be if you were to go buy, I don't know, some stock, and the first day it drops 10%, and you go, oh, that was a bad decision. But then the next month it goes up 50% or something. That first day does not mean you made a bad decision. And also vice versa. We had a new prospective client a couple of years ago come into our offices down in Appleton and meet with us. And he had not entire, but he had probably 80% of his net worth in one stock. And it was a really small company. He didn't know anything about what they did, but he had like $700,000 in this one company. And he took his success in that business. He put $100,000 in it, and over a course of 5 or 10 years, it went up to $700,000. He took that to mean that he was the next Warren Buffett, and he was not willing to really defend his wealth and take risk off the table. And he was in a position when we first met where he could have basically retired within the matter of, say, a year or two had he made some better decisions. But again, that resulting, he started attributing his success to kind of bad data. So what I would challenge you to do if you're watching this to try to overcome resulting is keep a prediction journal. So I have a journal. I don't write in it daily, but anytime that there's big events going on, so like back in mid-March, I was writing in it almost daily. Coming up into the election, I was writing in it almost daily, and I was really making predictions, and they were for nobody else's eyes. So I'm never going to come out and say, hey, I said do this and this happened and I'm right and blah, blah, blah. This was all about me breaking the habits of thinking in terms of just the result instead of thinking in terms of how good the actual decision was, knowing what you knew at the time, and really write down, keep track of what did you really know? What did you really know, say, before the election? What did you really know back when the pandemic hit? And write those things down. And what you tend to find is you're operating on a lot less information than you thought you were. When you look back in hindsight right now, of course, the pandemic doesn't look as scary as it did back in March. But in March, with the data we had, it was looking really, really scary. So anyone that was saying, hey, I've gone through the statistics and I don't think it's going to be as bad as everybody's talking about, they were making a pretty bold prediction in terms of how things were going to work out. And they were proven right. But a lot of times it's about what your reasoning was for that decision more than it was about the actual prediction yourself. So also write down, how confident are you really? So like back in late March, early April, when I was saying get really aggressive on stocks and stuff like that, I was pretty confident. I would put it at about an 8, but looking back in hindsight, it's like, oh yeah, I knew it was going to go up, right? Everybody knew it was going to go up. And you want to overcome that bias. So you want to actually put a number to it on a scale of 1 to 10. How confident are you? And oftentimes looking back, you'll start to go, wow, I didn't have as much information as I thought. Warren Buffett has this great line where he says, predicting rain doesn't count. Building the ark does. And having that journal, tracking your own predictions, and being ruthless. I mean, be absolutely ruthless about your own predictions, because nobody else needs to see it, right? It's your journal. You can keep this totally private. So moving on here, we're going to wrap this up with, I think I have 2 more. So the endowment effect is a really fun one. People are more likely to retain an object they already own than they are to acquire that same object when they don't own it. So we see this a lot in like experiments. And if you just Google like endowment effect experiments, there's a lot of fascinating experiments. But in general, how this affects your money is you tend to overvalue the current plan you have. You tend to overvalue the current plan you're on, and you tend to undervalue other outside ideas and changes to that plan. So like when it comes to investing, a lot of times, once you own a company, once you own a stock or a fund, you tend to place more value on it than if you didn't own it yet. You also tend to overvalue any current partnerships that you have rather than any new partnerships. People are just really resistant to change. And what I would say as a tip, and I don't know how clearly these lines are going to come through, but as a tip to overcome the endowment effect, flip the script. So what I mean by that is, let's just pretend right now that you're an investor and you walk into our office and you own this fund down below. You own this red line. That's the 10-year performance history. And we're recommending you not pay 2 or 3% a year in fees, and you not try to time the market, and you invest, long-term in high quality businesses for growth, kind of our philosophy and our approach to investing. And that's that blue line up there. Well, if we're showing you number after number after number, you might say, I don't know, this seems risky. I don't want to switch. I'm pretty comfortable. This is working, whatever. But if we show you this and we flip the script and I say, hey, Bob, pretend you already owned this blue portfolio. Could I get you to switch and move all your money into this red portfolio? Usually people laugh and say, absolutely not. And then at that point, they already know objectively what the right thing to do is. But it's hard to do. It's hard to get yourself to overcome that endowment effect. It's hard to get yourself to see the new path as the better one. And the best way to do it is to flip the positions. Pretend you were already on that new idea, that new path. How would you feel about switching back to the one you're on right now? And usually the answer will become really clear. So just to have a little bit of fun with that, if you're not already working with Tony and Eric, ask yourself this question. If I was already working with Safeguard, would I fire them to hire my current advisor? And I hope the answer on that's clear. I'm just having a little bit of fun, by the way. But we're going to move on to Dunning-Kruger effect. If you ever want to just have a lot of fun, learning a lot of new things, just go read about Dunning-Kruger effect. It's the most hilarious academic stuff I've ever seen. And here's what I mean. In a nutshell, the people with the lowest ability in a given area tend to have the most confidence in their ability in that area. So this graph over here, starting from square zero, where you have absolutely no skills in an area, let's say 5 or 10 hours into studying it, you now are more confident than almost everybody in the world. You think you know everything about it, and you're an expert. And then over time, the more you learn, the more your confidence drops and drops and drops and drops. And then when you start getting up into expert level, so the Warren Buffetts, the Charlie Mungers, the guys way out on the end here, they start to get confident, but you'll notice that their confidence is never as high as the brand new person. And this is really funny. So what you see is we've done this before in rooms where we're doing like a workshop or a seminar, and we'll say, everyone close your eyes. They all close their eyes. And we'll say, raise your hand if you're an above average driver. Everybody raises their hand. And then we say, of course, open your eyes. They open their eyes and look around, and 90% of people have their hands in the air, and everyone just kind of starts laughing. And you see this over and over again. Another big one is ACT verbal scores. So there was I don't remember if it was Harvard or Yale, but somebody did a big study on Dunning-Kruger, and they went back and said, please rate your verbal abilities on a scale of 1 to 10. And 9s and 10s and stuff like that were the only answer. And then they said, please send us your ACT score on whatever it was, like verbal acuity or whatever, the one English one. And what they consistently found across the board is the people that scored the lowest in reading and grammar and English and stuff like that on the ACT were the people that were rating their verbal skills the highest. And the people that were really experts, that had read everything and knew Shakespeare and, all that type of stuff, they were giving themselves like 8s. And then the guy with the 400-word vocabulary was giving himself an 11 out of 10. So you see this across everything. And with me, what I would say is I bought a truck recently, and I did a couple of weeks worth of research, and I was super confident in my pick. I did a lot of research on even that particular truck because it was a used truck. And I mean, I was crawling under it. I was looking everywhere, and I took it into a mechanic, and everything was great. I mean, for the first week or two, everything was totally great. The mechanic couldn't find any issues with it. And then one of the times I took it in to get an oil change, there was a small crack that got noticed by the mechanic, but it was in the leaf spring. So anybody that has a truck knows that I had to go drop about $2,000. So really quickly, my confidence went from up on this point here of I know everything about trucks to out in the middle where I'm going to have a mechanic inspect any vehicle I ever go by before I buy it again. So it's a little bit of fun stuff there on the Dunning-Kruger effect. And to try to overcome that, a good tip is to ask yourself, in any given situation, am I more confident than an expert? For example, right now, I would say, out in the market, you're seeing a lot of experts starting to take a little bit more risk, but they're still being very hedged. So they're optimistic. The market's rising after the election, stuff like that, but they're not like ramming all their money in. And if someone came to me right now and said the market's going to go up for the next 4 years, everything's going to be awesome, this is settled, it's great, we would have this discussion with them where we would say, hey, a lot of even the experts out there on the political side are not willing to say that the Senate race is even over. Like, are you really willing to jam all your money in here? And what information do you have that these experts don't have? Do you have an edge? That's kind of the term in finance and even in like poker and stuff like that. What is your advantage? What is that piece of information that you have that nobody else has that you're able to exploit to your advantage? And what you're going to probably find when you start thinking about your edge, like me in buying a truck, I don't have an edge. I don't have any natural innate advantage that I would have over an expert. So why not pay $100 to have the mechanic go inspect the vehicle before I pull the trigger on it, right? So I learned my lesson there, but it's a lesson I'm going to have to learn 50 more times because I'm a human being, and it affects all of us. So ask yourself, do you have an edge? If you're more confident than the experts, why? Obviously any of this stuff, it's all personalized. So any of these examples I've gone through, past performance doesn't mean future results and all that type of stuff. I just want to wrap up with a quick closing note. So some of you on this call are veterans, and I really want to thank you, not only just for your service, but for the life that I have in the United States. I mean, I get to go out and talk about behavioral biases and try to help wealthy people become vastly more wealthy. And my whole job is only possible because people like you went out and took the real risks. I'm not talking about financial risks, but the risk of like putting your life on the line, taking the ultimate risk, so that I'm able to help people, live a better life and live the American dream. And I from the bottom of my heart, want to thank you all for your service, and wish you all a very happy and grateful Veterans Day. And anyone watching this, if you have any questions about any of these, if you want to learn a little bit more about like Dunning-Kruger resulting or any of those types of things, give me a call anytime, 920-544-0576. Just want to remind you, you don't need more money. You need a better plan, a more objective plan that isn't falling into the same traps that all human beings do. This is Tony with Safeguard. Thanks so much for watching, guys. Take care.